Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Mitch Geisler from LevelJump Healthcare. LevelJump trades on the TSX Venture Exchange under the symbol JUMP or JUMP, and it also trades on the OTC under JMPHF. The company is currently trading at 8 cents with about 87 million shares outstanding, or about a $7 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trevor. Great to have Mitch with us today. Mitch, LevelJump's a name that I'm pretty sure that most of our subscribers are not very familiar with. So happy to have you here to tell us more. You've got your presentation deck up and running, so I'm just going to hand it over to you. Go take it away, Mitch.
Great. Well, I appreciate it, Trevor and Paul, and to all the listeners out there of your newsletters and what have you. I appreciate the time to listen and hear our story today, and I'm going to dive right in there, and then I'll look forward to answering any questions you may have after that. Before we get underway, I'll certainly flash the disclaimers so that all the security regulators are happy with us. And with that, we can start. And let's talk first about, who are we, obviously. So LevelJump, we'll refer to it as JUMP. We own and operate inpatient care diagnostic imaging centers, which are known as independent healthcare facilities. And we also supply remote radiology solutions, which is known as teleradiology for hospitals. We do this through our wholly owned subsidiary called CTS. So if you see that name come up, that's fully owned by LevelJump. And as we go through it here, I think some of the keys is that LevelJump, the company, we focus on urgent care, critical care for patients. We have a history developing and increasing revenues in the radiology space. And what we've really developed over the last couple of years in particular is both a telehealth and an in-person patient care facilities that allow us to make sure we're hitting both sides of healthcare. As we went into the pandemic, we heard a lot about telehealth companies and how they've grown, and it became kind of a buzzword. We've really been providing some telehealth services for really 20 years as it stands now. And now that we have some brick and mortar centers as well, it really allows us to be a complete healthcare company. We established in 2004. So as I mentioned, we have over 20 years now, almost 20 years of experience. And what's important to note is that we have great history and track record of increasing our revenues. A lot of it is organically, which is really important. We deal with government as the main payers, so we don't have to worry too much about accounts receivable, which in other healthcare companies, especially when you're dealing down in the States, it can be a big mess at times. So it allows us to have a predictable revenue stream and balance our books and budget accordingly. As mentioned, we provide in-person staple healthcare services. And what's also important with LevelJump, so we're a services company. It's not a technology company, but it's a service that is about urgent care. It's a service that everybody accesses. And we've proven that it's recession-proof, it's pandemic-proof. We continue to grow through the recession, through the pandemic. And I think those are key points when you're looking at safe havens to put your resources, or penny stocks as ours may be, when you're looking at what penny stock is going to be there in 2 years, what penny stocks can be there in 5 years. And with us, you're going to, as we go through the presentation, you're going to see our vision and our history and where we're going. And I think hopefully you'll see that it lines up. Our mission is to alleviate the stress and backlog that's burdening the Canadian healthcare system. And we strive to find solutions that expand critical care for everyone, that generate revenue and growth opportunities. Our growth strategy is pretty simple. We want to scale, so we want to add a patient physician network by acquiring complementary clinics and healthcare services that fit within our umbrella. We want to expand by building out new and existing what we call IHF clinics and offer additional services such as urgent care procedures. And over time, we want to diversify, and we're going to talk a little bit about what that will entail later on in the presentation. So looking at some of the highlights over the last year or year and a half, we surpassed 9 million in revenues last year. We released our Q1 financials a few weeks ago, and when those came out in May, we're now tracking over $11 million for this year, and we already know we're going to have substantial growth heading into the fourth quarter. So we expect that to increase even further. So we continue to chart a path of substantial growth year in and year out. Also last year, we went from just a telehealth company to purchasing X-ray and ultrasound clinics known as IHS. So this is where you would go to physically have a X-ray and ultrasound, mammography, any kind of diagnostic image like that. So that we have 3 clinics that are currently operating that we purchased last year. And then late last year, we also purchased a license. So it's important to understand that these clinics in the province of Ontario, you can't just open a clinic. You have to have a license. The government generally doesn't grant them. So they do cost a substantial amount of money. So we were able to purchase a license in a key area, kind of the northern end of the city of Toronto. And we're opening up a new, what we're calling kind of flagship space. That's going to have state-of-the-art X-ray and ultrasound equipment, as well as offer some urgent care facility services, which we'll get into shortly. We also added new teleradiology contracts. So teleradiology is the process whereby we're supplying remote radiology services to hospitals for urgent care. So these are patients that go into a hospital, and using the hospital's equipment and technologists, they will have a CT, an X-ray, and ultrasound for a variety of urgent care needs. The hospital will take the CT, and then they will page our doctors, and our doctors can view the images and provide a read report. So that process is called teleradiology, and that's our telehealth aspect, and really the company was founded on. Currently, we're developing new operations for both inpatient and online urgent care, which we're going to get into. We also do own 25.5% of our biggest teleradiology competitor. We are a passive investor. They run their business, we run ours, but it is important to note that we do own a quarter of that company. And that doesn't, it shows up in our financials as a note, but not on the revenue side, because we're not over 50%. So let's talk a little bit more about the business so that everybody understands what we do. So as mentioned, and where we want to go, we have the independent health facilities, or IHFs. And we mentioned we have the 3 of them that provide various imaging needs. And we're building out the new center. The new clinic we're building should be open sometime between late summer and very early fall this year. It's being built as we speak, so it'll just depend on when the equipment and everything arrives. And we're looking forward to that. We also have recently announced that we're hopefully closing shortly on 4 clinics that we're buying in Calgary, Alberta, in the Calgary area. And that's going to add substantially to our bottom line, because these clinics have been around for a number of years and they're doing well. And I'm going to get into the numbers on those shortly as well. Our teleradiology services, as I mentioned, it's a little unique for a telehealth company. A lot of people, when they think telehealth, you might think you're calling up on an app, calling the doctor, and that's how you're speaking to them. And it's about patient acquisitions on a daily basis. But for us, our telehealth operations, we actually are contracted by dozens of hospitals throughout Ontario. And these hospitals, obviously, they're getting the patients from their local community, and then the hospital is the one that's hiring us. So instead of a B2C approach, our telehealth to date so far has really been a B2B approach, which is a little bit different, and I think puts us in a unique position of developing new synergies with hospitals, new potential opportunities down the road, and differentiates us from other companies that may be out there. We read everything from MRIs, CTs, X-rays, ultrasounds, whatever the hospital and its emergency rooms may need. And this has allowed us to be established as a leader in the hospital, in the teleradiology space. As mentioned, there's basically us and our competitor that we own 25% of. Basically, we retain about 20 to 25% of the reading fee with little overhead. So the gross margin on the telehealth side is smaller. On the IHF side, the gross margins would be in about the 35 to 40% range, closer to 40%. In the telehealth side, they're about 23% right now. However, there's very little overhead with it, as mentioned, because we don't have any brick and mortar other than our head office, because doctors read from their personal houses, wherever they're living. So we don't have to pay rent. There's no machinery involved. So it is that's where we kind of make up on those margins, because we're able to keep a lot of that profitability. And that's why we've had 3 quarters now of positive adjusted EBITDA. Our CTS solutions assist with understaffed hospitals, overworked radiology group, and shortages at emergency care centers. So really, we're an important cog in the urgent care side of healthcare within the province of Ontario. So as mentioned, basically our current operations, whether it's our IHS or our teleradiology, the patients will arrive at the hospital or at our clinics. So at the clinics is where we actually own the equipment, and it's our technologists who are providing the scans. As mentioned, at the hospital, we just do the radiology reading. We don't actually take the scans. So the patient would arrive, and from there, they're going to receive their CT, for example. And then that CT is sent to our radiologist, whether that's in the hospital or our clinics. Obviously, we have our own radiologists that read our clinic work as well. They're able to log on from wherever it is they are. They're all located in Ontario and in Canada. They'll be working from home, not from a hospital. And then the CTS prepares that report, which is then sent back. And in the case of the hospitals, the ER physician gets that report in real time on a CT within 60 minutes. We do stroke protocols where they'll get a report back within about 20 minutes, so they can proceed with urgent patient care at that point. And for our IHF clinics, the reports are disseminated back to your referring physician that told you to go get the ultrasound or X-ray or what have you in the first place. So you can see from this chart, easy to understand the kind of patient workflow, if you will, what it is that we're doing. And you can certainly see how there's synergies within the field of radiology between both our telehealth and in-person care. So we want to look at our future channels of expansion and things that we're working on. Right now, we have kind of positioned ourselves well. We've been developing, and we're going to have more on this coming out shortly. And that's what two things that we're calling. One is called telehospital, and that's going to be remote physicians to patient ER consultation services, triage that can be performed via video conferencing to a CTS doctor, nurse, or specialist, and provide solutions for overcrowded emergency rooms, resulting in reduced wait times. And there's a website up now called telehospitalcanada.ca. It's just a splash page right now. There's a lot of work being done in the background. So everything before this slide that I was talking to everybody about today has to do with our current operations, where on this slide, we're talking about our new growth opportunities that we're looking to expand into. Hopefully, we're going to have this open, if not later this year, early next year. And then we also have what we're calling Urgent Care Canada. And Urgent Care Canada is going to be where we establish within our existing clinics a new model for the way we look at critical care. Right now, a lot of people, they go to emergency room or a walk-in clinic, except that a walk-in clinic is limited in what it does, its scope, if you will. In many instances, patients go to a walk-in clinic if they just need a simple antibiotic. If there's anything more substantial needed, they generally are told to go to an emergency room. The issue with that is emergency rooms are overfilled, busy. They can wait 10, 12 hours there. And we see a lot of instances where people hold off on going to an emergency room because they don't want to go through that, which obviously is not good for your health. So as we expand our IHF clinics, we're going to add to that, including at our flagship one that we're building out now, more of a US urgent care model that will allow us to offer several services that are all applicable and allowed under the current insurance premium guidelines. And we're going to be able to hire the right physicians, assistants, and nurse practitioners to bring on to perform those kinds of care for patients that are needed. So we're going to kind of redefine the urgent care. The way that urgent care and telehospital actually tie in together. So sort of the way our radiology existing operations tie into each other. These are very similar. What we want to do is on our telehospital, we're going to give access to hospitals in rural communities that we now service. We're going to go to them and say, hey, you also don't need just radiology specialists, but you have other physicians, whether it's neurology, urologists who can do consultations. Some of it has to be done in person, but what can be done remotely, we're going to be able to offer these services to hospitals in small communities that may not have all the specialists always on hand, because this is an ongoing problem between small urban or rural communities versus the big city in Canada, throughout the country, not just in Ontario, because we're so spread out and there's a lot of small communities. So telehospital is going to allow us to address that need, as well as Urgent Care Canada. It's kind of how it'll look here when you go to the telehospital canada.ca website or .com website. It'll have a patient portal that will also keep all your information and allow you to input more information if you like from other doctors, so that way you can have everything in one place. As many viewers may know, here in Ontario, for example, they've wasted billions of dollars trying to establish one system where you can access records. It's still not great. And in addition to that, that doesn't really help the patients. There's a few different companies that offer patients the opportunity to access their records, but there really isn't a place to keep all of your records. And this will afford that opportunity for those that wish to use that service. So that's kind of our operations that we're working on developing right now. In addition, that we want to roll out later this year and early next year. Going back to our new clinic, as mentioned, we're hoping to open that in Q3, if not sooner than that. And it's located in a high traffic area. It'll be our first location in the GTA area. Our other ones now are east, kind of between Toronto and Kingston, for those who know the Ontario region a little bit. We also, in addition to having the X-ray and ultrasound services there, we want to open the first urgent care operation in that location. We've already planned it and the space is being built out now. So after that, we also have our Alberta acquisition that I made reference to. And there's been a few press releases if anybody's going back and looking at it. We have a proposed acquisition, which we're hoping to close later this month. And that'll be in the Calgary area. The purchase price is $5.7 million. The facilities have X-ray, ultrasound, bone, mineral density, and fluoroscopy. And combined last year, they did revenues of $4.75 million, and they have a EBITDA of $873,000. So it's really important when we're talking about Jump, we look at a couple of different things. First, our current operations, as mentioned, all have double-digit increases year over year. We want to look at organic growth. So every time we have a business, how can we increase its pie, increase its revenue stream? Because that's our role, obviously, and our ambition. And then when we look at acquisitions, we're looking at how is that going to benefit us today. So we're generally looking at acquisitions that complement what we have and already have revenue streams coming in. And in this case, as you can see, by the model. They're already doing really well, which means a good chunk of that money is just going to fall to our bottom line and enhance our profitability and positive cash flow. So we're looking at organic growth, acquisitions that are doing well, that are going to add to our pie and not burden our system. We're not looking for flailing businesses that we hope we can turn around. And then, of course, we have the urgent care side, which we think complements our critical care that we already offer. And we really are kind of experts on that side of healthcare. We do currently have a preferred offering that's outstanding. I'll just leave it here. Anybody can contact the company afterwards. We can talk about that. Just happens to be in the deck right now. There is also some press releases on that offering. Our capital structure is, as we mentioned, 87 million shares. Management, myself and the CFO, we own about 26 million shares of that. So around close to 30% of the company. And then there's warrants out there, a bunch of them, most of them expire actually over the course of the next year. And then there's some options and what have you. Our focus right now with our current acquisitions, with our current operations, as mentioned, based on Q1 revenue, we were at we're projecting right now over $11 million. Once we open our Young Shepherd clinic, we should be doing adding a few $1 million once it's in full swing to that. And of course, the Calgary acquisition would be adding another 4.75 million. So really, we're a company today that's 11 million, but as we move forward in the coming months, we could be on a track later this year to doing over $20 million based on our build out and the acquisition that's on the table right now that we're hoping to close. The board consists of myself and our CFO, and then we have 3 directors that have various backgrounds running big businesses. A couple of them run $100 to $200 million companies, and actually all 3 are CPAs just by coincidence. So we have a lot of accounting background and expertise as well as business background on there. So it's Rob and myself, and we handle the day-to-day operations. And then the board consists of Jackie, Gary, and Richard. This deck is also available on our website, so certainly invite anybody to look at that afterwards as well. And then we do have an advisory board that consists of 2 radiologists that do work for CTS, and they're an important part who we can lean on for medical expertise, if you will. And with that, that's the presentation, and I'd love to take some questions and just have an open discussion.
Fantastic. Thank you so much, Mitch. I want to remind everybody that's listening, if you've got some questions you'd like me to ask Mitch, please use the chat function and I'll ask the question. Mitch, in the markets you're in right now, so a question I always ask is sort of like addressable market or total addressable market. How do we envision that in a case like yours? You're somewhat limited geography, I guess, but how should we get an idea of what you could generate in terms of revenue from your existing facilities?
Yeah, so really, as far as the facilities, each one is a little separate. So like some facilities we have, we could build out more, like we have the room, it's already there. For instance, we have a couple of clinics in the Belleville area, and one of them we have extra room. It's just the way the lease is and that there's a lot of space. So we're looking right now at adding modalities. We did add in the wintertime another ultrasound machine and expanded hours. So that's one way. And then certainly we can look at adding more modalities to that, whether it's fluoroscopy, bone mineral density, and what have you. But then we have another clinic where it's kind of almost maxed out, if you will, just because it's got no extra space in it. So it's hard to say it on an individual basis. What I can say is that there's a lot of clinics that are owned by like mom and pop shops. A doctor owns like 1 clinic or 2 clinics. So there's a lot of opportunity there for for acquisitions as we move forward across the country, which is really important for us to close the Calgary acquisition, because we really want to branch out of Ontario into, another province as well. So we think there's a lot of opportunity there. The clinics in Calgary, a lot of opportunity for growth. Right now, I'd say, they're doing just under the 5 million as I discussed, but all total, I could see those clinics doing in the $7 to $8+ million range, if not more, because there's room there for expansion. So it's like one of the reasons we like the acquisition so much is that it's solid footing now, excellent cash flow, doing really well, built a nice reputation, but it's not maxed out, and we have that opportunity to increase revenue.
So, I mean, you mentioned space, but what else do you need to be able to handle an increase in business? Is it equipment? Is it people? Is it what else? All the
People.
above.
That's the word coming out. That's the word coming out of the pandemic, right? It's all about people. Yeah, it is a lot. It just depends on where you are. Like, for us, that's one challenge when you're in smaller communities. So our current IHFs, we do run into that where it's like, okay, if we add this, do we have a technologist who lives in the area who will work for us, right? Because it's limited. We don't have a lot of competition, but that also means there's not a lot of people. Where the store we're opening in Toronto, while there's a lot of competition, there's also a lot of technologists in Toronto, so it'd be much easier to acquire them if you're a well-run company. So it's a little bit of that, and there would be some as well. You got to add a modality. You can always expand, generally speaking, with your current modalities. This is in Ontario, so if you want to add another ultrasound machine, like one of our clinics has 3 ultrasound machines. If we want to add a 4th, we can. If you want to add another X-ray machine, you can. But if you want to offer, let's say, bone mineral density, then we have to see if we can get a license and approved for that. So some of it could be regulatory, some of it is manpower. The equipment really is the easy part insofar as it's just a cash transaction, right? Like you can always go and buy equipment that's easily readily available.
And then you touched on competition a little bit. I just want to get a better sense of what the landscape looks like. You said mom and pop operations, I believe. Is there anybody of size kind of doing what you're doing? And is it really, where there's a lot of fragmentation, a lot of small operators out there?
Yeah, so on our teleradiology side, there's us and the company I mentioned that we own a portion of. We're kind of the 2 main players really in Canada. After that, there's some kind of in areas you'll see in kind of regional players, like within a certain area, sometimes doctors get together and they'll form a teleradiology business just to really support the hospitals in the local community, but they don't treat it as, oh, how could we blow this up across Canada or at least across the province or what have you. So I'd say we're kind of us and the other company are the main 2 teleradiology competitors. In terms of the IHFs, there's thousands of them throughout the country. There's pockets of where there's some players that own like 15 or 20 IHFs. There's nobody like in the blood test space. You have some of the labs out there, and they are really like across the country, if you will. There's 2 or 3 companies that we go to for our blood testing that are really right across the country, but that's not the case in terms of the IHFs and the clinics. There's a lot of doctors or business guys who own 2, 3, 4 type of thing, and then I'd say there's a handful across the country where they own like 15, 20, 25 clinics, and then that's pretty much it. There's no national player.
Gotcha. And let's talk in terms of how many opportunities you think there are out there, and then secondly, so what's the typical terms of some of these acquisitions you guys are making?
Yeah, I think the opportunities are, they're not endless because they're not infinite, but there really is a lot of opportunities. I mean, and there's nothing stopping us as we get bigger, looking across the border, where I have experience as well, and I've been in that field. So really, there's a lot of opportunity. Our philosophy, or our vision, rather, not our philosophy, but our vision is, okay, we're at 11 million. We have a path to 20 million this year. how do we get to 50 million and then to 75 million? And then it just keeps snowballing from there, right? Because the one thing is each business generates cash, and that's really important. So, we get to the point where we can keep acquiring companies and we'll get bigger and bigger, and eventually it just snowballs, and for us to become a prominent player. Sorry, the second part of the question?
Well, just what are the typical terms that you see when you acquire these businesses?
Yeah, the terms, it depends on the province. Yeah, so for instance, in Ontario, the licenses, because they're hard to get, you can't just open a clinic. So the multiple higher, like even when we acquired our clinics, we paid like 8.5, 9 times for the existing clinics. And we've seen people pay 10, 11 times. We won't pay that high. Our kind of philosophy is we've gone as high as we're going to get for our first one, and then that was it. And now we won't pay as high, because obviously we want to make money on it, right? We don't want to work just to pay down the debt. In Calgary, in Alberta, we're paying about 5.25 times EBITDA, or almost just 1.25 times revenue. And that's because there, the licenses, it's easier to open up a clinic. It's not as regulated as it is in Ontario. So it just depends on the province. So certain provinces, they're all regulated differently, if you will. Kind of like we have 11 different security exchanges in every province in Canada. It's a little bit like that. So it changes everywhere. So generally speaking, in the radiology or diagnostic imaging space on private clinics, if they're doing well, you're going to pay about 5 to 6 times, assuming there's no regulation that adds to the value of the license. And if they're doing like good but not great, then you're probably going to look to pay 3.5 to 4.5 times.
Gotcha. And synergies. What kind of synergies do you get out of these type of businesses, if any?
Yeah, we do when we acquire them. I mean, they're like right now we have our radiologists that work both for our teleradiology side, and then they can also support our clinic side and act as quality assurance, medical directors, things of that nature. So there's a lot of synergies there. The from a head office staff point of view, if you understand one side of the business, you can understand the other side. So it saves us the amount of people we need. We don't need a large size head office, if you will. I mean, obviously we'll need more as we expand, but there's that there. But really, one of the keys is as we grow and focus, say, hey, we're this kind of leading radiology company, to now saying we're a critical care company, right? And that's where the telehospital and the urgent care side come into things. There's going to be a lot of synergies there. So for example, when we have the urgent care clinic at our new flagship facility that we're building out, about 5 or 6 patients out of every 10 that go to a walk-in or urgent care clinic can need imaging. Well, right now we're going to have, the way we're building it, we're going to have the imaging right beside it. So imagine you come to ours for urgent care. That's better than a walk-in clinic, and it's almost more like a hospital. Like, oh, you fell and you broke something. Maybe we can just go right next door and take the X-ray, right? And we can do that right away. Or you're having these cramps. Okay, we can do the ultrasound on the spot type of thing. So there's a lot of synergies that play in there. And then, of course, that means we also have doctors on premises, which is always adds to the procedures and the types of imaging that we're able to do in the long run when we get things like fluoroscopy with pain management and that. So there's going to be a lot of synergies as we grow more. Additionally, on the telehealth side, because we have the ins already with dozens of hospitals for our radiology services, as we bring out the telehospital side, we can say, hey, we already have the connection to CEOs and to chiefs of hospital to say, hey, have you guys thought about this? Because we can offer you, this type of service now for additional specialists other than radiology.
Gotcha. Do you see any specific trends in the industry, in the sector that affect you either positively or negatively right now?
The biggest potentially positive, we just don't know yet, is in Ontario. The Ford government announced over the winter months that they want to grant about $45 MRI or 40 MRI licenses to help with the backlog and allow you to open up MRI. Right now in Ontario, you can't. There's no private MRI clinics. There are in Alberta, in Quebec, and BC. Although BC is it's sort of regulated, it's a little bit different. In Ontario, you can't. So it's just getting kind of passed now, the bill, and we're waiting for more details on it. Whether or not we're fortunate enough to get an MRI license, we don't know yet. But certainly that's something that's positive. Really, in healthcare, I don't want to say that there's nothing negative. It's just that healthcare is so important that it's a big focus of government. So it's usually more positive than negatives. Like another positive was through the pandemic, governments and hospital CEOs, they changed the way they looked at healthcare. So now what we've realized is and patients as well, telehealth is something that's important, right? Like we're saying it's here to stay. I think we had on one of our slides where like 70% of people say they believe in some kind of telehealth as part of their service, not all their service, because you're still going to need to go to the doctor for various reasons, but it's certainly encompassing. And what we've seen is that they've changed sometimes codes in different jurisdictions to allow for telehealth and encourage that, which is really good to see. So that gives us a lot of hope that, you know, the model that we're building is actually the way the future is going for healthcare. And that's really important when you get billing codes that favor you already, that puts us in a good spot.
Yeah, gotcha. Let's talk a bit more about the sort of the business or the finances of the business. Capital requirements you have. I mean, you've got a financing that's open right now. What are your sort of future capital requirements do you figure over and above what you're raising right now?
I kind of have to be careful on some of the stuff I say there. I can just say that we're going to get sooner than later to a point where the capital raise is not going to be a big part of what we need to do. It's not, because each acquisition is making money and we're already creating cash flow positive. We already have positive adjusted EBITDA and we continue to chart in the right direction. So we don't see us needing to continually go back to the market. We do have the round open now. We would like to close on that and raise so that we can make sure to close on the Alberta acquisitions, you know, and maybe there'll be another round after that at some point, but it wouldn't be like right now, because we really want to focus on the growth of the company. And I think that will allow us to go. We have been fortunate, and just for the audience, people that don't know, is TD, one of the big banks in Canada, has been a partner of ours for the last year and a half, and they continue to work with us and showing a real interest in healthcare and what it is we're doing. And I think that says a lot about our company and management and our ability to show the bank to take faith. You know, when we did our acquisition last year, they partook in both acquisitions, you know, for $3.5+ million, you know, and we've been paying that down. So they're really happy, and they've shown an appetite to continue on with us. And we think that's really great for all shareholders of our company, because, you know, there's a lot of different financings out there, and some of them aren't always favorable to the company, and sometimes they put the company in a real bind. So we're quite proud of that milestone and having that continued relationship with a big six bank.
Very good. Awesome. What sort of the biggest challenge you face? What sort of keeps you up at night?
What keeps me up at night? What doesn't keep me up at night?
One
of them we alluded to before was actually people, whether it's doctors or technologists. That keeps me up at night because there really is a shift in lifestyle that we've seen coming out of COVID. And I don't mean to keep reverting back to the pandemic. It's just that it's played a key part in where healthcare is today, whether positively or negatively. So that certainly keeps me up. And then, you know, it's really just focusing on our vision, because I believe we're right at the cusp right now. As I mentioned, like, yeah, we're at 11 million, except that we're already building out our flagship clinic in Toronto here. So that's not like a dream, like it's going to happen. And obviously I want it to be really successful, and our acquisition in Calgary. And if we close on that, then, I said later this year, we're charting over $20 million, doing really well, positive EBITDA, not just adjusted EBITDA, but positive EBITDA. So I think this is really a critical time for us. I also think it's a time when, investors that are looking at us say, okay, well, look where the stock is, but look what the company is showing that its model works. Because you can go back and look at our audited financials since we've been public the last few years and see the growth there. So I think it's a really unique opportunity to look at us. And I just hope that we continue with that vision, because I think with that and the new businesses we want to bring in, that $30 million, once we get to 20 million, that 30 to 40 million is really obtainable, because it's just that snowball effect.
Yeah, fair enough. Got some questions that have come in. Let's see if we can get some answered. Got one says, from the proxy, can you get some clarity on this? Going to vote this year, settling outstanding debts to consider, and if deemed advisable, to pass with or without variation, an ordinary resolution of disinterested shareholders to approve some sort of non-arm's length party debt. The question is this insider debt looks to convert shares at a discount plus 25%? Does that make any sense to you?
The question makes absolute sense, except that the last part is incorrect.
Okay,
it's at a premium to market, not a discount.
Oh, okay, sorry. Okay, yeah, it says plus 25%.
No, that's fine.
So it should have been that.
Yeah, it's some insider debt. It's not a crazy amount. I think it could be a couple $100,000 in total. I would invite anybody with questions afterwards, certainly to follow up with Caitlin, our head of investor relations, and she's in-house. It's not an outside company. She has direct access to me all the time, and my team. So I invite you to please follow up with Caitlin if you need more information on that. We can certainly get the details, but it's actually at a premium. I think it's at 12 cents, if I remember correctly, off the top of my head.
Okay, gotcha. Perfect. Okay, next question. It's does Mitch know or understand why Robert Landau is buying so many of the December 2023 warrants that are exercisable at 50 cents when the stock's only at 8 cents?
Well, your listeners and viewers have done their research. So
they do.
Fantastic. I think those actually are both great questions, because it tells me they're sophisticated watching it.
Yeah.
They were just being purchased. They're available. We were supporting the market, and you just never knew what was going to happen in the future. So we would just were buying them up rather than just letting them expire. It was just a personal choice that he made.
Okay, fair enough. Okay, next question. Why did LevelJump invest in Real Time Medical and in Shaw Lens?
Okay. First off, Shaw Lens, because we sold it, I don't want to spend too much time on it. It was Shaw Lens was a special lens company that we believed a lot in, and both actually Rob and I, the CFO, we were introduced to the company before we took LevelJump public, and we really liked the potential opportunity. So we brought it to our board because we believed we had a fiduciary responsibility, since we did know about it while we were running CTS, and the board agreed. So we decided to buy it. In the end, it didn't go exactly the way we wanted, but we sold the position. We made like a 50% return on the investment, so it's fine, and we move on. And part of the reason was also just we're too busy to help them with what they need, because it's just not in our wheelhouse. It's not exactly what we're doing right now. So we were like, we really need to focus on that. As far as Real Time, it was just an opportunity that was presented to us, and you never know when you start to acquire a percentage of a competitor where it may go from there, and it may lead to great business opportunities. It's really all I can say on that. They are operating, and they're probably around our size, so it's still a good investment. How it pans out ultimately for LevelJump shareholders and for us, we will see, but we're very confident in that investment.
Fantastic. Okay, so are telehealth services more profitable than diagnostic imaging services?
Tough question, because there's a million different fees, so it's really hard to just say one. I would just say they're both profitable, and you can do well with both. I wouldn't say one's necessarily like, in my example, our gross margin on in-person versus telehealth is different, but of course there's less expenses when you have the telehealth side. So I wouldn't say one's more profitable than the other. They're just different, and both can add substantially to the pie.
Gotcha. Okay, so one more question from the viewers here. Okay, so what EBITDA numbers or operating cash flow numbers do you expect to generate at sort of a $20 million revenue run rate? What can we think through there?
At around $20 million run rate, we should be somewhere hopefully in about the $2 to $3 million in EBITDA.
Okay, fantastic. Good. Okay, so that's sort of the viewer question side of it. We're sort of near the end here, and what I always like to ask is, like, we're investors and we're watching you run the business. What do you think are the key metrics or sort of catalysts that we should pay attention to right now to really understand that you're sort of continuing on your business model?
I think they're the opening of our clinic, hopefully the close of our acquisition, but really, I think if you look at our recent history, you can see that we've had growth each year, both organic and new contracts, so that we've delivered, we've established a business that has proven itself. We've shown that management has the ability to continue to grow the operations. We've talked today about a couple, probably 3 or 4 different milestones between acquisitions and new businesses that we're developing. So I think, you follow those. If you're someone who says, I'm not sure, but I'm interested, then you follow those. And as we start delivering more on those, you'll see that we're meeting what we told the market that we were going to do. And at the end of the day, we're here for all shareholders. And, our goal is to build a successful company that benefits everybody.
Fantastic. Is there anything we missed? Or more importantly, is there a key takeaway or parting message you want to make sure everybody walks away with today?
I don't think there's anything we missed as far as the message. I think maybe this is too blunt for a CEO to say, but I'll say it. I know at times our story is not sexy because it's not technology driven, and I know a lot of people like that. But when you're looking at junior companies, and I know there's a lot out there, you want to also say, okay, but who's around and who's going to be around? And when the music stops and some of these telehealth companies you've seen that were big during the pandemic, for example, but they're losing money, except that our revenue grows. And now we've had a few quarters, 3 quarters of a positive adjusted EBITDA. With our acquisitions, we've kind of laid out that we're going to continue on this. Hey, we're making money and we're going to continue to make money. So I think that's really important. And you want to look at a management team that's been around and has the seasoned veteran experience within the industry. And very lastly, the fact that we specialize in urgent critical care, even just with our radiology services, I think makes us a little bit different than other healthcare companies because there's not a lot that deal in our specific field.
Fantastic. Mitch, thank you so much. We've been speaking with Mitch Geisler, CEO of LevelJump Healthcare. Symbol is JUMP, Jump, on the Venture Exchange. Mitch, thanks so much for joining us today.
Thank you very much. I appreciate everybody's time. And again, if you have any questions, please reach out to Caitlin on our website, leveljumphealthcare.com. You can find it in the investor section, and she'd be more than happy to answer any questions.
Fantastic.